So, Bob, I think the big question on investors' minds right now is, are we going to party like it's the late 90s? Because it seems to me like we have pretty hot financial conditions right now, right? Markets are an all-time record high, which is awesome. We have the Fed cutting interest rates just like they did in the late 90s, which did eventually cause the tech bubble and the tech bubble to burst. Do you think what we're seeing right now in the stock market is similar to what was going on back in the late 90s when you had the same haircut?
Well, don't forget, guys, we started this podcast, we were talking about the roaring 20s. And, everybody reflects back on the original roaring 20s and say, oh, wait a minute, that didn't end very well, right? But, we have had 4 periods like that, right? We had the 50s, right after World War II. We had a big booming roaring 50s. We had the 80s and 90s was a big booming bull market. And I got to tell you, we're in one right now. This is the roaring 20s. And there's a lot of similarities or a lot of parallels, but you take a look at what's happening right now. This economy's booming.
No, it really is. I mean, from every metric you're looking at right now, you couldn't look for a better place to be in terms of like, should you be invested? Yes. We have relatively loose financial conditions, right? We have oil prices are down a lot this year. That's a tax break for everybody. Globally, governments are cutting interest rates around the world. That's stimulative for everybody. In addition to that, we've seen long-term rates come down a little bit. Mortgage rates become a little more affordable. So, and now the Fed is cutting interest rates because they claim, which I don't know if I believe, the employment market's about to fall off a cliff. But I don't know, Chris. It just seems like, man, oh man, as an investor right now, the animal spirits are out and financial conditions are loose.
Yeah, no, it's true. And I think we're going to see more of it too. I mean, especially given the fact that Feds have cut rates, got a lot of money in money markets to the tune of like, what, 7 trillion? So that money's got to find its way somewhere back in the market. They got to get that yield somehow.
Yeah, but you also look at the economy, guys. What's the number one driver of the economy?
Spending. Americans spend money, Bob. They love to spend money.
And the one area they haven't been spending money on because there's a scarcity is the housing market. I mean, when have we been through a big bull market where the housing market wasn't the backbone, of that expansion, right? Because people go out and they build new homes, they buy furnishing, buy services. So, if these rates come down, I mean, that's a whole nother leg up if we get the housing market back on track.
Well, the only problem there is we have a housing shortage in this country. So it's not so easy to say that, hey, I'm going to go out and buy a house when there's so limited inventory that we have already. And let's face it, going from 7% down to 6.33% or 6.4% where mortgage rates are today, it doesn't solve the unaffordability problem. So I don't know. That part of the economy still seems like a problem to me.
Hey, cry me a river, Rye.
I know one person on this podcast that won't be buying a house.
Mortgage rates are 22% when I bought my first home. It's like 6 months.
Yeah,
really
but
good.
Your house is like $5,000, Bob.
A lot more than that. It was 5,000 square feet. I know that much.
Wow, 5,000 square feet.
But the thing is, you have that whole part of the economy that has been lacking, right? That hasn't been there. And if there's not enough housing, maybe you should call Bob Toll back in Philly and tell him to start building more homes. I mean, this has got to be a dream come true for the home builders.
And maybe Payne Capital Management needs to get into the real estate industry and start building homes. I know Ryan loves that idea.
Yeah, I don't think I would make a great contractor, that's for sure. But I think, the point is right now is, it's your point, Bob, actually, there's a lot of places in the stock market that benefit from the fact that we have these loose financial conditions. We have an economy that's heating up. And it's not just the big bull market in tech, right?
Sure.
This year, Chris, surprisingly, you would think the U.S. market was one of the number one markets in the world this year, but it's not. We're actually near the bottom in terms of performance. There's so many other places that are doing well, which says to me, Chris, that maybe it's time to actually broaden out your exposure as an investor.
Yeah, I think it's always a good idea to be broadening out your portfolio, especially given the fact that, some of these high flyers like the Magnificent Seven are so high right now. It's like, where's the value have to happen? And to your point, yeah, international's taking off. Not only that, emerging markets, real estate, all those things are doing really well. And hey, guess what? They all pay dividends.
They do. They all pay dividends, Chris. And look at all the parts of the market that are beneficiaries of lower interest rates, right? Small to mid-sized stocks, right? Their earnings estimates are now starting to take off because they borrow short, they borrow floating rate. So you're starting to see those stocks catch a bid. I'm so sick and tired of watching these talking heads on TV tell me how Europe is uninvestable and China is uninvestable and India, as these markets go up 30% year to date, I'm thinking, well, when are you guys going to get in, right? After you wait for that confirmation. And that's, I think, the hardest part about investing, right? It's like, people want certainty. When you have certainty, it's time to sell.
Yeah, and I think it's the human behavioral component. And if you look at it, and there's an article in the Wall Street Journal about this, that there's like $7.3 trillion still in money market funds right now, which is a huge number, right? And the question is, well, your interest rate keeps going down. Is that money going to leave the money market fund and find its way in places like the stock market? And I would argue the funny thing about that article was they're saying, no, people like to have, cash on hand. They want to reserve that money's not going anywhere. I call BS. What I think humans do is they look at the last 3 years, 4 years, 5 years track record of the stock market, and they're like, man, get me all in. And I think that's the big risk here. There could be a huge melt up just because the Feds continue to cut interest rates and money's got to find a home. And we know how investors like to pick their investments, right? What was hot recently?
Well, the irony of that is that, when you start to see rates go down, you're losing that income. And to your point, Rye, that money's going to find its way into the market. And the thing that's the hottest, those things don't pay any dividends. So they're going to end up losing that income that they're so much craving.
Yeah. Meanwhile, the market's been appreciating at a phenomenal pace, and you miss out on that compounding effect. But, just think about how human nature, how it kicks in, how it hurts you as an investor, right? The bottom of this current big booming bull, right, was when the short-term rates hit 5%. And we had all these investing geniuses calling us up saying, well, if our goal is to make 5% and I can lock it in to a one-day treasury bill, why wouldn't I put all my money there? And now they're sitting there, well, wait a minute, those stocks that I sold are up 40%. Should I get back into them now? I mean, did I miss something?
Yeah, you missed a lot. And I think that's where conventional wisdom is really dangerous when it comes to investing, because if you remember, this wasn't that long ago. We had 5% interest rates coming out of last summer, which that's not long ago at all. August 2024, you're getting 5% of your money market fund. And every investment specialist or expert was saying, well, cash is a position. Well, it's not, because that rate continues to go down. And to your point, Bob, the market continues to go higher here. So I think you have to be really careful about where you're putting your money right now. Like, look, don't fight the Fed, right? That is probably one of the greatest, adages you can live by when it comes to stock market investing. 100%, right? Everything is telling you right now, the tea leaves are telling you should be invested. But Chris, I think it's really critical how you invest your money right now, right? You can't just blindly buy what's been hot. That's not usually the best strategy when you're trying to build wealth long term.
So I think what you're saying, Rye, is that we should go 100% into Bitcoin.
You took the words right out of my mouth.
Well, it's funny. I think the oldest investment adage that I know is buy low, sell high. But we all know the average investor buys high and sells low. And even with U.S. markets doing so well, there's still a lot of great discounts to be had up there. Even though international has done so well this year, still pretty cheap, pretty good buy. Emerging markets a good buy. Real estate's still a good buy. A lot of great places to put your money and get great value.
Well, I think that's, as I've said this a number of times on the podcast, is that the worst thing for an investor is for your neighbor to get wealthy investing and speculating in something, right? The green eyes come out. The jealousy is just extreme. And the fact of the matter is, we have just had outperformance from just about every asset class. I mean, people say, oh, well, I hope value kicks in. Value is like 30, 40% above its average rate of return over the last, 20 years. It just isn't up as much as large cap growth. So I think that the whole idea of, having a portfolio strategy, investing based on your goals, which is our brilliant strategy, that's the only thing that really matters. And it's really, that is the governor that you need to keep on your emotions. It's like, you don't need your neighbor's rate of return. You don't need CNBC's rate of return. You need the rate of return to get you to where you're going.
Yeah, I think that's part of it. I think the other part of it is just thinking strategically, right? The old famous Wayne Gretzky quote about skating to where the puck is going to be. And let's face it, there's a lot of large macro trends right now, whether it's the fact that the dollar has been tanking, right, versus other currencies, whether it's the fact that economic growth is heating up from where it was the first half of the year, right? It's actually accelerating right now, even if the Fed says we're going into a slowdown, which I don't believe, or the employment market is falling off a cliff, which I don't believe. And in addition to that, you have the Fed that's cutting interest rates, which is very stimulative, but it also benefits certain companies, like smaller companies that need to borrow more. And that goes right to the bottom line when the borrowing costs go down. And they're tethered to the fact that the economy is actually starting to heat up, right? That's why you call these stocks cyclical stocks, because they follow the economic cycle. So, I think you have to start, when you're allocating your portfolio, you have to start thinking about what's going to benefit next, not what's been benefiting for the last 5 years, 10 years, 15 years. And that's clearly been the tech trade. And I think that's the mistake we see most investors make, is they just don't have enough money in all these other pockets that are doing just as well this year, that probably have a pretty long time horizon, given the fact that these macro trends are real and they're happening right now.
Well, we haven't spoken about economists for a while, but now I see them telling me, well, we're probably going to have a soft landing. I mean, these economists have been looking for this recession that never shows up. And, this is an economy that, doesn't have to land, right? It's been flying high for the last couple of years, and no one seems to know that. But, the good news is there are a lot of people worried about a lot of different things, right? What happens with these tariffs, guys? What if the Supreme Court comes back and says all these tariffs that have been placed were done unconstitutionally? What do you think is going to happen to the market if that happens?
If I knew, I'd be on my yacht, Bob, and we have to pay back that $90 billion or whatever that we've already taken from these companies into the government coffers that we hope will go to pay down a little bit, or at least balance the budget, try to balance that budget this year.
Yeah, and will we get all that investment that some of our foreign partners have promised?
Hey, hope you're enjoying the most recent episode of the Pain Points of Wealth podcast. Everything you hear on this podcast, along with some due diligence of your own, can help you get ahead financially literally at any stage of your journey. But if you want a more hands-on approach and you saved over $1 million for your retirement, Bob, Chris, Courtney, and I will run for you our total financial master plan, and we'll do that with no obligation or cost. It's a full holistic review. We literally look at everything. We'll go as far as building you your own personalized financial portal. We'll give you a bird's eye view of your entire financial life and hone in on every financial issue you need to address today, whether it's an income plan for retirement. How do you take Social Security? How do you draw from your portfolio, factor in inflation, and don't run out of money? We'll look at diversification. Markets have been wild over the course of the last couple of months. Has your portfolio been up and down? Or have you been sitting in cash, CDs, money market funds, paralysis by analysis? We'll put together a full investment game plan. We'll show you how to grow your wealth, but most importantly, protect it over the rest of your life. And we'll look at fees and taxes. Wall Street loves to sell you high cost, tax inefficient products, whether it's an annuity, mutual fund, insurance product, structured product. We'll do a deep dive of every investment you own. We'll show you how to reduce the cost and optimize your portfolio for taxes. It's not what you make, it's what you take. You'll get a full tax playbook, and we'll do this full review at no cost. We'll literally go through everything for you, do all the work up front. Simply go to www.paynecm.com/financial plan or click the link below to see if you qualify for a free financial review. Well, I guess the question is too, do you agree with the Fed, Bob? Do you think the Fed should have cut interest rates? Do you think that they are spiking the punch bowl here, so to speak, with the economy already heating up? Do you think in retrospect, the Fed's going to look foolish, I guess is the question.
Well, I think in retrospect, the Fed always looks foolish. The Fed is always wrong. It's always late to the party. It's, hey, look how long it took them to raise rates. We spoke about inflation ad nauseum on this podcast. Go back and listen to how we were screaming at Jerome Powell, like, you've got to get ahead of this. And, I don't know if it was political motivation or, he was just trying to save his job or what the point was. Everybody knew it but him and his committee, which is, kind of, disconcerting. But, they're late to the party here. Rates should have been cut, I think, a little earlier.
Oh, you think they should have cut them earlier? I think the opposite.
I do.
I don't think they should be cutting at all.
No, I think they should have cut them earlier. And the market, you can see, look, the market's smarter than everybody. And you can see how the market's reacted to it. They're loving it. And I think that, I'm surprised that we're expecting 2 more cuts, but I'll take it.
So Chris, Bob is dovish. He thinks the Fed should have, he's typical baby boomer. They should have spiked the punch bowl hours ago. Why are they doing it now? Do you think that the Fed they should be spiking the punch bowl, or as the famous Fed chairman from the 1950s, William McChesney Martin, I've been practicing that all morning, said that the Fed should be a good chaperone when the economy's heating up, which it is, and financial markets are heating up. It should be a good chaperone and take the punch bowl away. What do you think is the more prudent move here? Spiking the punch bowl or taking it away, Chris?
Well, first of all, I think Trump would have fired him for saying that. He wouldn't have lasted 20 years. But, I to some extent agree with Dad. I love the fact that the market's really taken off right now. It's been like gasoline on the fire. But, the one thing I am concerned about is if we start to see inflation longer term with the economy heating up so much, that could be ripe for inflation increasing. And then as far as 2 more cuts, I don't know. They said 5 cuts for this year and they only made 1. So I'm not sure that that's coming down the pike, but we'll see.
Chris, I'm getting a little worried about Ryan. For a guy who doesn't drink, he's really focused on this punch bowl. Like maybe we ought to take him out for a beer.
A secret about the pain points of wealth, as I give Ryan a little shot of scotch before the podcast, loosen him up a little bit.
Anything to take the edge off, Chris.
That's
Anything
right.
to take the edge off. I appreciate that.
Yeah.
But no, I think your bigger risk here is, we're creating asset bubbles. And I'm not an economist, but when a company called Gemini Space Station went public 2 weeks ago and went up 30%, it's down since then. And literally they hold like cryptocurrencies. I made this joke the other day. We should name our company Payne Capital Space Station, start buying crypto assets, and our valuation will go to $1 billion. But I have to think to some extent here, this looks a little bit like the late 90s with all the crazy IPOs. You have a lot of unprofitable companies like OpenAI, right? It's one of the biggest AI companies. They make no money. They're not going to make it for years. And they're being subsidized by companies like Nvidia. Like, it does feel a little bit like the wild days of the late 90s. No? Yes? Maybe so?
Oh, it is. But every expansion is like that. I mean, you have winners and losers. You're going to have, you have a new technology. Let's face it, guys. I mean, it's going to have a huge impact for years. At least the market thinks it will. I read an article the other day, and it talked about the 3 most popular investment with the individual retail investors right now is, you guys can guess it, right? It's Nvidia, it's Palantir, and Tesla, right? They're buying that all day long, trading it all day long. And I think that's the question you have to ask yourself as an investor, right? If everybody's talking about the same companies and everything's known about those companies, where's the opportunity, right? So you own those companies, own large cap growth. Make sure you have that in your portfolio, but make sure you have money in the things that no one else is talking about, right? The things that you're not hearing, when you go out in the golf course, you go out to dinner. People don't brag about an investment unless it's way overvalued or unless they made a lot of money on it. So they don't tell you about it when it's early, when the opportunities are there. So I think the Bobism that really applies here, the Payne principle of wealth, is that diversification is the only hedge against uncertainty. And, we've been talking about a lot of good things going on right now, guys, but there's a lot of uncertainty out there right now, right? We've got global geopolitical risk. We've got all kinds of, problems that are happening around the country. So there's plenty of bricks in that wall of worry. So, just remember, when it comes to your money, it's better to be approximately right than precisely wrong. You don't need to have every investment, buy it at the bottom and sell it at the top. That's a recipe for disaster, right? You want to be long, but you want to be diversified.
Thanks for listening to the Pain Points of Wealth. Hopefully, you found the ideas discussed in this episode valuable and useful for your own financial journey. You can find out more about Bob, Ryan, and Chris's firm, Payne Capital Management, at BeBullish.com or through the contact information found in the description of this episode in your podcast player or app. Join us next week for another episode of The Pain Points of Wealth, brought to you by Payne Capital Management. Information provided on today's show is provided for informational purposes only and does not constitute investment, tax, or legal advice. Investment is obtained from sources that are deemed to be reliable, but their accuracy and completeness cannot be guaranteed.